If you're into personal finance, making money, and getting rich, you've probably heard of the Nasdaq, S&P 500, and DAX. But is just knowing about them enough? Do you really know how they work and why they're so crucial to your investment portfolio? No? A bit cloudy? Don't worry, we'll make it simple for you. Think of them as a basic thermometer that you can check to see how good a company is doing. This information is valuable when it comes to investing. In this video, how stock indexes impact the market, how they actually work, and how you can use them to invest smartly. Hello and welcome to The Winning Journey. Stay tuned till the end of this video if you want to know where to invest your money for profits. There are going to be quite a lot of secrets along the way. So, with that in mind, let's begin. What is a stock index? Ever heard the phrase, the market was up today, or the market was down, and thought to yourself, what does that really mean? Well, these phrases refer to indexes, and if you're curious about investing, you need to know how indexes work. The easiest way to understand what is a stock index is to think of it as a tool that you can use to understand the health of a company. But it doesn't measure every company out there. It measures the overall health of a group of major companies and gives a snapshot of how the economy is doing. The companies that are part of the index are usually the most influential and the largest ones in a country or an industry. It averages out the stock performance of each company into one number, and that number is what moves up and down based on how the companies are doing. Think of it like a football league table. Each team's rankings affect the overall league rankings, so if the top teams are performing really well, the ranking goes up. If they aren't, the ranking goes down. The same thing happens with the stock market. For example, the Nasdaq is heavily weighted towards tech companies like Nvidia, Apple, and Microsoft. So this means that if the tech sector is booming, the Nasdaq goes up. Understanding what these indexes are and their importance is crucial to investors, because these indexes don't just represent individual stocks. They represent entire sectors and industries, and that's why they need to be used to make decisions. How do stock indexes work? Alright, so now that you know what a stock index is and why it matters, let's look at the calculations. There are two main ways in which stock indexes are built. These include market capitalization weighting and price weighting. The market capitalization weighting is used by indexes like the S&P 500 and Nasdaq. The simple way to understand this is that the bigger the company is, the more it moves the index. Let's take Apple for example. Say that it's worth $3 trillion, and another company that's also listed on the same index is worth $30 billion. Given these figures, Apple's weight is 100 times more than that of the other company. So, if Apple's stock drops by 10%, it can drag the entire index down a lot more than what would happen if the stock of the other companies dropped. Now, let's look at the price weighting index. This index is mainly used by the Dow Jones Industrial Average. This method only looks at the stock price, not how big the company is. What this means is that if a company's stock is trading at $500, it affects the Dow more than a company whose stock is trading at $50, despite the fact that it belongs to a larger company. So, as far as the index calculations and movements are concerned, it can shift based on the company size or the stock price depending on the method that's used. And as a smart investor, you should always check which method is being used. The most famous indexes: Nasdaq, S&P 500, DAX. By now, you've learned what a stock index is and how it generally works. Let's build on that and look at three of the most famous indexes: the Nasdaq, S&P 500, and DAX. Building familiarity with these indexes and understanding how they work is essential, as it can help you make better and more informed decisions as an investor. Nasdaq. The first index we're going to cover is the Nasdaq. This index has major tech giants such as Apple, Amazon, Microsoft, Tesla, Meta, and more. So, if a company is a major tech stock, chances are it's listed here. But is the Nasdaq just about tech companies? The answer is no. It includes companies from a variety of sectors including healthcare, media, entertainment, and more. However, the index still focuses on the tech sector, and since technology itself is quite volatile, especially with the rapid advancements nowadays, That volatility carries over to the index's performance as well. As an investor, if you're comfortable with this type of volatility and know where the tech industry is headed, then this index is for you. S&P 500. The next index we're going to talk about is the S&P 500. It has 500 of the largest publicly traded companies in the US that come from different sectors, including tech, finance, healthcare, and more. These companies are big names like Coca-Cola, Alphabet, JP Morgan, and more. This index works based on the market cap weighting method, so big companies can influence the index's performance. However, since it has 500 stocks, investors do get some options for diversification. What this means is that if one sector dips, another may rise and things get balanced, meaning somewhat less volatility. Apart from that, since it has 500 of the biggest companies in the US listed on it, investors often use the S&P 500 as an overall measure of how the US economy is doing. If the index is up, it means the economy is in a good place. As an investor, if you're looking for more stable and long-term options, the S&P 500 is the right fit. In addition, if you've ever invested in a retirement fund or ETF, chances are you're probably exposed to the S&P 500 already. DAX. Last but not least is DAX. This is Germany's flagship index that only has 40 companies. This number might seem small, but these are major global businesses that have been around for years. Examples of such companies include BMW, Adidas, Siemens, and so on. These companies are tied to trade, exports, and manufacturing at a global level. The index is important because it doesn't just represent Germany. The country is a major economic player in Europe, and changes in the DAX don't just represent Germany's economic performance. They can be used to gauge the performance of the entire region as well. A unique thing about DAX is that it is a performance-based index that pays dividends as well, unlike most of the other indexes. This index is a suitable option if you're considering having capital in European markets or industries. Now that you're familiar with 3 of the most famous indexes, if you had to invest in one, which one would it be and why? Let me know in the comments below. Overall, if you want to invest in one of these indexes to further diversify your investment portfolio, the Nasdaq will be your go-to option if you're comfortable with high-growth, high-risk investments. But if you're someone who prefers a more balanced, long-term approach, go for the S&P 500. Lastly, if you want to invest in foreign markets like Europe, then DAX is the index you should be looking at. Why do stocks indexes matter? For investors, want to know how successful investors succeed? Here's the catch. They don't spend years trying to figure out how to beat the market. They invest in the market itself using indexes. When it comes to stock indexes, you need to know that they aren't just numbers on a screen. They are powerful tools that offer 3 key advantages to investors. These include simplicity, performance tracking, and risk management. Keeping these benefits in mind, let's start with exchange-traded funds, ETFs. This investment option gives you the benefit of simplicity. ETFs track a specific index in particular, like the S&P 500 and the Nasdaq. To make it easy, think of an EFT as a shopping basket that's filled with companies listed on an index. So, when with this investment vehicle, you don't have to buy 500 individual stocks, you just buy one ETF share that's cheaper. Apart from that, it diversifies your investment. There's no guesswork or constant checking involved. You just buy it and let it grow. Next up is benchmarking. Investors use indexes as a benchmark to measure the success of their portfolios. What this means is that if the S&P 500 is up by 10% and your portfolio is only up by 4%, your strategy needs a little tweaking. On the contrary, if your returns are higher than the index, then you have the right strategy in place. One of the biggest benefits indexes have to offer to investors is diversification. It's no secret that when you invest in a single company, you're always at risk of losing your capital if the company crashes. But with indexes, your investment is not tied to one particular business. It's spread across multiple companies. So, if one fails, the other balances it out. Because of these 3 benefits, investing in an index is crucial if you want to build long-term wealth. So now the question to ask yourself is whether it is better to invest in ETFs or try to pick a winning stock yourself? Let me know what you think in the comments below. Future trends and smart strategies. We already talked about stock picking strategies here at The Winning Journey, but stock indexes, like everything else, are changing, and they're changing fast. As an investor in 2025, you need to know what's headed your way and how you're going to deal with it. Let's start with the Nasdaq. It was once known as the Tech Index, but now it's rapidly becoming known as the AI Index, as all the major tech companies are pouring a ton of money into AI. What this means is that the Nasdaq is leading the next wave of tech innovation when it comes to investment. As an investor, you need to remember that the potential for growth is high, but because of the volatility, it does come with an inherent risk. Apart from that, the S&P 500 is diversified, but when you dig deeper, you'll notice that some of the biggest companies listed there are tech as well. So the index still is diversified, but just not as much as it used to be. Now, if we move over to the DAX, Germany's flagship index, the big companies in it are mainly in the automobile industry, tech, and finance. Again, these are companies like SAP, Siemens, BMW, and others, and they drive much of the EU economy. It only has 40 companies, so it can't compete with Wall Street when it comes to size. However, it does offer exposure to the European market and is worth considering for investors. So what should you invest in during 2025? To figure this out first, you need to know what type of investor you are. So, with that in mind, let's break the answer down based on investor types. If you're someone who's just starting out, you need to go for broad market ETFs, given that they are simple and low maintenance. Apart from that, you get diversification and exposure to some of the top US stocks. If you're an investor with a more global mindset or approach, consider the Vanguard Total International Stock Index Fund ETF. With this, you can hedge on regional growth and capture international growth. If your focus is on the EU market, then go for the DAX ETFs. Looking at this from a risk perspective, if you're someone who likes to play it safe, diversified index ETFs are the right option for you as they come with little volatility. Apart from that, you should look for ETFs with dividend-paying stocks. Lastly, if you're an investor who likes to take risks, you should focus on options like the ARK Innovation ETF that have higher potential for growth, but higher risk as well. Above all else, you must remember that all investments come with risks, and you need to know what they are regardless of the type of investor you are. With indexes, rates can go up when a tech giant comes forward with the latest innovation, or they can decrease because of global tension, all of which create volatility for you as an investor. Now that you know how stock indexes work, go ahead and test your knowledge. Do you want to know how to invest without making any mistakes? Subscribe to The Winning Journey so you don't miss out on future finance and investment-related content. Thank you for watching.